One of the big hurdles for mass adoption of crypto is the hurdle is to be removed so that big players can move in and out of crypto in ways that they're used to. Those bridges have to be built and be ready to go before institutions and sovereign wealth will come in with larger funds. One of the companies building a very important bridge is Definity. Today, Manu Choudhary, CEO and co-founder of Definity, joins us to share some of that news. Could you share with the audience what is Definity and what does Definity do?
Yeah, sure. Let me give you a little bit of background on me as well, just to give, I guess, people that are not familiar with Definity or me a bit more context. So I'm Manu Choudhary. I'm the co-founder and CEO of Definity Markets, and essentially, Definity Markets is a electronic trading venue for funds, for banks, and for also institutional investors for digital assets, so crypto, but also fiat on and off and fiat to fiat. In terms of my background, before I joined fintech, I spent about just under 18 years working in cross-asset derivative sales, working for a couple of UK investment banks. So most recently, Lloyd's Financial Markets, and prior to that, Barclays Investment Bank.
Can you tell us a little bit more about Michael and Ashwin and the rest of your team?
Yeah, sure, cool. So look, all of us have a background in TradFi. So essentially, I spent 18 years working in various banks. Michael's background is low latency electronic trading. So he's worked for the New York Stock Exchange. He's also worked for companies like Gain Capital. Ashwin likewise has worked for, again, electronic trading pretty much most of his career. And then essentially Chris, who's our CFO, again, he spent most of his career in banking at a couple of UK banks also. So, we're all markets guys. We all are very familiar with sales and trading. That's kind of what we've done pretty much our entire career. And so our expertise and our experience really is in traditional finance. As a team, our background is really in trading and sales, cross assets. So again, I've got experience in inflation, also interest rates, commodities, but mainly foreign exchange. Chris is mainly fixed income. Michael and Ashwin are equities and foreign exchange. One of the biggest attractions for me to join the world of fintech was really seeing the evolution in 2017 of digital assets, and essentially when the penny dropped about the uniqueness of Bitcoin, i.e., the first time that humans had created digital signatures that couldn't be forged. It was very obvious to me that this was just the beginning of something pretty huge in terms of the transition from, I guess, traditional finance, or TradFi, as everyone calls it, to a digital ecosystem. But there are differences. So, for instance, if I do an FX trade and something has gone wrong, I've settled the wrong leg or something, I can unwind the trade, I can cancel it. The problem is when something is written to a layer one, all deals and all trades are final. It makes it quite difficult. So you have to have an additional layer of authentication to make sure that you settle the right number of trades. So that makes for an added degree of complexity. And I think that's where a lot of people have got very confused, and they spend a lot of time and effort and money building a solution. We've got a very innovative solution that's very innovative, and it's something we've developed over the last couple of years. So one of the founding principles that we really had for the business was to have a more open, more accessible, and more transparent financial markets for every single institutional participant. And if you know anything about the institutional market for foreign exchange, which is really my background, you'll understand that there's a lot of credit counterparties. There's a lot of intermediaries. There's a lot of ways of taking credit risk and offsetting that risk. With the digital asset market, because it's so young and so innovative, that doesn't exist. So what we did, or our USP, is we are the first firm in the world to partner with an investment bank and to allow you to trade digital assets without counterparty risk. So in essence, what we have is we've separated trade execution from custody of fiat and custody of digital assets. So if you have a portfolio of bonds, you can place that with our partner bank. And again, I think we're the only people who can do this. And you can, within 20 milliseconds, trade on our platform. When it comes to the crypto assets, you either have them in self-custody or use a credible custodian, such as a bank in New York Mellon or a State Street or a Fidelity Digital Assets. So what this allows counterparties to do is allows counterparties to essentially trade crypto that otherwise would not be able to. When you speak to these fund managers and you say, look, what are your pain points? What are the problems? What are the issues you face? They will all tell you the same things. And we kind of sat down and said, okay, look, We could make a super, super fast, low latency piece of very smart tech that just matches prices. But we don't really fix any problems by doing that. The biggest headache a lot of fund managers have is really accessing the market. They all sit there because they're obliged to hold government bonds. But if they could then use them as collateral to trade crypto, that is absolute genius. And that's kind of, and by the way, I say this like we did this very quickly. It took us a hell of a long time to do, but we could offer this now. So we can do this.
You're an overnight success, 3.5 to
Yeah,
5 years in the making, right?
yeah, something like that. So we can do this, but and obviously, look, within reason. Obviously, U.S. government bonds, no problem. UK gilts because we're based in London, of course. German bonds, Japanese government bonds to begin with, and then obviously we may expand that to other G7. If you've got Greek sovereign debt, then yeah, good luck with that. But that's not us. One of the real bits of innovation that we've done here. So let's say you have a market maker who's making prices and a consumer, let's say a fund manager. If, for instance, one of those counterparties doesn't settle the trade, if you're on let's say an OTC desk, you're a little bit screwed. If you're on exchange, you have a problem. With us, we don't because we have the legal recourse to go into their account to make the other side whole. So no one ever loses in our ecosystem. So we've genuinely mitigated counterparty and credit risk.
What's interesting is I've often thought about why are institutions not coming into crypto? There's certain safety rails that have to be there for them to do it in a big way, because what they found out with FTX is custody problems. If you sent money over to FTX, you had no guarantees they weren't sending that money somewhere else. That was kind of like, oh yeah, trust us. But we see how that turned out.
The main issue we've had since the FTX collapse, which again was a concentration of trade execution and custody, is that a lot of the asset allocators that give money to fund managers have said, look, you can trade whatever you want to trade. But the reality is you have to face a credit-worthy counterparty, i.e., does this counterparty have a Moody's or Fitch or S&P credit rating? And the answer is nobody does. But the bank we're partnered with actually has a AA minus credit rating. It's got a $1.5 trillion balance sheet. And most of the asset managers are already connected. Now, you may think, look, why is this relevant to the world of crypto? And the simple answer is, if you look at the assets under management in the world of asset management around the world, it's about $130 trillion. So there's about 21 fund managers that manage more than $1 trillion. There are 3,000 fund managers that manage between 100 million and $1 trillion. And there's about 12,000 below 100 million. These are huge numbers. Imagine that you saw them allocate, I don't know, 1% of their AUM to Bitcoin. You would double the market cap of Bitcoin overnight. And that's if they do 1%. Imagine if they did 5%. And that's kind of what we're trying to create. We're trying to create the accessible market conduit for these traditional finance institutions, who, by the way, have all got an interest. And I want to make it an exception to a couple of these guys. So obviously, let's think about people like BlackRock and Fidelity and also Vanguard in a slightly different way. These guys are behemoths. They're so enormous. They're big enough and ugly enough to do whatever the hell they want to do. They are not the norm. You have thousands of other fund managers that want to get into this marketplace, but they're unable to. And what we've allowed them to do through our mechanism that we've created in partnership with our European investment banking partner is a way for them to access this market in a safe way where there's no counterparty risk. Banks publicly are clearly very anti-crypto. Privately, they look at it as a new asset class and they are seeing the big shift. And I've got to be entirely honest with you, the biggest driver of this has actually not been our contacts in sales and trading. It's actually been the guys on the bond origination desk. So you may or may not know, but last October, UBS Bank were the first bank to issue a digital tokenized bond. And this was the first bit of the innovation. If you know anything about how banks work, the guys in the capital market side, so the guys that work in proper investment banking, they're the guys that make the biggest risk-adjusted return for banks. It's not, sadly, the guys like me that take credit risk and counterparty risk with clients on the sales and trading side. Sadly, we're the pariahs of the investment banking club. But the proper investment bankers, the proper Wall Street heavyweights and the guys in the city of London and Canary Wharf, those guys, obviously, they look at this and think, okay, we make our money by issuing bonds. How do we do this? Well, we take a client, we take their details, we work out roughly what a credit threat should be, We then underwrite the issuance and then we sell it down to a syndicate of 20 or 30 other counterparties. The problem is, or the issue for them, is that when you have a digital bond, you don't need a bank anymore. You can do it yourself. And this is exactly what Siemens did in March of this year, which I think the whole market thought, oh shit, this is a problem. So suddenly everyone's running at a million miles an hour to say, right, the only way we're going to hang on to these very, very lucrative, very fat margins is if we do it ourselves. And that's exactly what's happening. So if you Google digital capital markets, you will see a lot of banks that are setting up desks that will issue these bonds. And to give you context on this, the global bond market is worth 135 trillion and the global loan market is worth 226 trillion. Imagine what that would do to the market cap of crypto.
That's fascinating. Bonds are a perfect example to be on the blockchain, right? It's something to
Absolutely.
be on the blockchain. And just because of market pressures is finally pushing them to go digital because someone big finally did it.
And then on the other side of the coin, there's a whole bunch of crypto natives that need to do things, simple things like foreign exchange, they can't do because banks won't face them. So we're happy facing those counterparties because we have an existing FX business where we do over $1 billion in FX every single day. So having the crypto natives plug into us electronically is very easy. Doing fiat on and off is again very easy. We've got 16 banks we work with at the moment. Some of these guys are some of the biggest banks in the world. The one weird thing, and this is a very strange situation, is if you look at the United States dominates every single bloody marketplace in the world. There's not an industry these guys don't dominate in America, apart from crypto, where ironically the US banks, apart from JP and Goldman's, who obviously are always ahead of the curve, they're a million miles behind the European banks. You know, it's the European banks. So, for instance, Commerzbank today was the first bank in Europe to get a crypto license. You know, Deutsche Bank about a month ago was one of the first European banks to get a custody license. This is a really interesting thing, and I can tell you that we're speaking to half a dozen European banks, and they're all very interested in pushing forward with market making in crypto. And again, the interesting thing about this is not because they're so interested in crypto; it's more to do with the fact that they will use this as a beta test to eventually trade digital bonds. And if you look at banks like SocGen issued the world's first bank-issued stablecoin on the Ethereum layer one. Now, okay, it wasn't great. It's a bit crap. I'll be honest. They've done a mediocre job. But the fact of the matter is, who would you rather trust, USDT or the second largest bank in Europe? There is eventually going to be an inflection point. I think when you have the critical mass of banks that are issuing digital bonds, you're going to have a huge change of mindset because bonds are already regulated. They're already securities. There's no ambiguity. There's no confusion. Is this security or not? Yes, of course it bloody is. And that I think is going to be what drives the SEC to begin to make some actual proper sensible decisions. At the moment, I'm confused by some of the logic and rhetoric they're using. It doesn't make a lot of sense. And hey, if they want to kick a $1 trillion industry to the UK, I am more than happy to embrace that with open arms. One of the big things I'm keen to push is at the moment we have one European investment bank that is our partner. It is only a matter of time before we have two or three or four or five. And look, we're speaking to half a dozen as it is. Once we have a critical mass or a cohort of, let's say, two or three, some of these banks are already trading crypto. Not that this is in the public domain, but they will come out publicly and they will begin to announce this. So we will be one of the first platforms that they connect to get bank liquidity from. So at the moment, it's all non-bank market makers, the likes of Wintermute, BTC2, Cumberland, those kind of guys are kind of plugged in. They will be replaced very quickly with the banks because the banks have got balance sheets and they are very, very keen to get into this market. The second phase of innovation will be from the ultra high net worth / private banking guys. Already seeing it a lot with the Swiss banks. They're very active, very aggressive. This will change in the next couple of years, where you see many more banks come in with their ultra high net worth desks. So you're going to see two waves of capital come in. One is going to be the asset managers who are interested in buying and hold. By the way, my favorite kind of investors, because all they do is add quality to your market cap. The second phase is going to be the ultra high net worths. They may be buy and hold, they may trade. I don't know. It may be a combination of two. And then if you add to that, what will happen with the retail environment once you have, again, mainstream adoption of bank issue stablecoin, which I think is probably the better and safer alternative to central bank digital currencies, which I'm not a big fan of, then I think those three things happening in the next 24 months are going to be absolutely crazy. And they are going to drive the bull run. Obviously, we have the halving next year of Bitcoin. that is a huge milestone. But I think 2024 is going to be huge for Bitcoin and crypto in particular. And I think you're going to see genuine mass adoption.